What if I told you that one single company is now worth more than $5 trillion, and yet the very analysts who study it every single day still think it's undervalued? That company is NVIDIA. Right now, NVIDIA carries a market cap of $5.51 trillion, making it one of the most valuable companies on the planet. But here's the twist that catches most people off guard. Even after climbing 25.42% over the last 52 weeks, analysts believe there's still 41.66% of upside left. So, what's really driving that confidence, and does it actually hold up once you look under the hood? Let's find out. NVIDIA has 24.15 billion shares outstanding, and that number is actually shrinking, down 1.04% over the past year. A shrinking share count usually means a company is buying back its own stock, making each remaining share worth a slightly bigger slice of the business. Only 3.92% of the company is owned by insiders, while a massive 70.47% is owned by institutions, meaning the big professional money managers are heavily positioned here. Now, valuation is where a lot of investors get confused. NVIDIA's trailing price-to-earnings ratio, or how much investors are paying for each dollar of past profit, sits at 28.83. That sounds expensive, but the forward P/E ratio, based on expected future earnings, drops to 19.01, a big shift that suggests the market expects serious earnings growth ahead. And that's not even the most surprising part. The PEG ratio, which adjusts the PE ratio for growth, sits at just 0.39. And a number under 1 is often seen as a sign a stock may be reasonably priced relative to how fast it's growing. But before you get too comfortable, here's a contradiction worth pausing on. The price-to-sales ratio is 18.17, the price-to-book ratio is 24.04, and the price-to-free cash flow ratio is 43.34. Meaning investors are paying over 43 times the actual cash the company generates each year. The enterprise value to EBITDA ratio is 27.23, and enterprise value to free cash flow is 43.16. So depending on which lens you use, this stock can look reasonably priced or extremely expensive. However, one number changes the picture when we shift to the balance sheet, because valuation alone doesn't tell you whether a company is fragile or bulletproof. NVIDIA's current ratio, a measure of how easily it can cover short-term bills, is 4.59, and its quick ratio is 2.92, both very strong. Debt to equity is just 0.17, meaning very little borrowed money. And here's a number worth letting sink in. Interest coverage sits at 425.82, meaning operating profit could cover interest payments over 400 times. This is not a company worried about debt. Now let's talk efficiency, because this is where NVIDIA really separates itself. Return on equity is 117.21%, return on assets is 53.57%, and return on invested capital is 92.03%. Compare that to the weighted average cost of capital, essentially the minimum return needed to justify money invested in the business, which sits at just 16.32%. That gap between 92% and 16% represents real value being created, not just revenue being generated. Here's a number most people completely overlook. NVIDIA generates $7.21 million in revenue per employee and $4.59 million in the profit per employee across a workforce of just 42,000 people. That's an extraordinary amount of financial output from a relatively small team. On the tax side, the company paid $36.86 billion in income taxes over the past 12 months, an effective tax rate of 16.05%. Let's shift to how the stock has actually been trading. Beta, which measures how much a stock swings compared to the overall market, sits at 2.21, meaning NVIDIA moves significantly more than the market average in both directions. The 50-day moving average is $208.16, sitting above the 200-day moving average of $195.73, a pattern often viewed as a sign of upward momentum. The Relative Strength Index, a scale generally running from 0 to 100 that shows whether a stock is overbought or oversold, sits at 61.32, a fairly neutral to slightly strong reading. Now here's an angle most retail investors never even check. Short interest essentially bets that the price will fall, sits at about 286 million shares, or just 1.18% of shares outstanding. But here's the interesting part. That's actually down from about 293 million shares the previous month, meaning bearish bets against NVIDIA are shrinking, not growing. It would take short sellers about 2.35 days of average trading volume just to close out all of those positions. Now let's step into the engine room, the actual income statement. Over the past 12 months, NVIDIA generated revenue of $302.97 billion. Gross profit came in at $226.24 billion. Operating income at $197.58 billion, and net income, the actual bottom line profit, at $192.88 billion. Earnings per share landed at $7.91. In plain terms, an enormous portion of every dollar that comes in the door turns into pure profit. That profit shows up clearly on the balance sheet, too. NVIDIA holds $62.47 billion in cash against $38.86 billion in total debt, leaving a net cash position of $23.61 billion, or 98 cents per share. Total equity, or book value, sits at $228.98 billion, and working capital, the cushion of short-term assets over short-term liabilities, is $154.39 billion. This is a company with far more resources on hand than it currently owes. On the cash flow side, operating cash flow over the last 12 months was $134.36 billion, while capital expenditures, the money spent on equipment and infrastructure, was a relatively modest $7.35 billion. After depreciation and amortization of $3.69 billion free cash flow, the actual cash left over after running and investing in the business came out to $127.01 billion, or $5.26 per share. This is where investors often get confused between growth and profitability, so let's separate the two. NVIDIA's gross margin is 74.67%, operating margin is 65.21%, and net profit margin is 63.66%. In plain terms, for every dollar of sales, the company keeps roughly 63.66 cents as pure profit after everything is paid, an extraordinarily high margin for a business operating at this scale. Now, you might assume a company this profitable pays a large dividend, but that's not really the story. NVIDIA's annual dividend is $1 per share, a yield of just 0.44%. That dividend has grown 1,200% year over year, though only over 2 years of growth, so that big percentage reflects starting from a very small base. The payout ratio, the share of profit paid out as dividends, is just 6.58%, meaning most profit is kept and reinvested rather than distributed. Add in the buyback yield of 1.04%, and total shareholder yield comes to 1.48%. It's also worth knowing NVIDIA's last stock split happened on June 10, 2024, a 10-to-1 forward split. A split doesn't change the actual value of an investment, it simply divides each share into more shares at a lower price, making the stock more accessible to trade. Here's a hidden strength most casual investors never look at. The Altman Z-score, a formula estimating how likely a company is to face financial distress, sits at 34.85 for NVIDIA, an extremely high reading that signals very low bankruptcy risk. The Piotrowski F-score, a scale from 0 to 9 that grades overall financial health and quality, sits right in the middle at 5, a neutral reading rather than a glaring weakness or a standout strength. So what do the professionals expect going forward? According to the 61 analysts covering this stock, the consensus rating is strong buy, with an average price target of $322.95, 41.66% above the current price. Analysts are forecasting revenue growth of 55.4% and earnings per share growth of 58.73% over the next 3 years. Now, separate from what analysts are projecting, let's look at whether those numbers hold up based strictly on the data we've walked through. On one hand, the case for that kind of growth is backed by real fundamentals, a return on invested capital of 92.03% against a cost of capital of just 16.32%. Minimal debt, interest coverage in the hundreds, and free cash flow of $127.01 billion, all pointing to a business with the strength to keep reinvesting and expanding. On the other hand, several valuation multiples are already pricing in a lot of that future success. A price-to-free cash flow ratio of 43.34 and an enterprise value to free cash flow ratio of 43.16 mean investors are already paying a steep premium today for growth that hasn't happened yet. So based purely on the numbers provided, the analyst forecast doesn't look unreasonable given the company's profitability and balance sheet strength, but it's not a conservative projection either. It requires NVIDIA to keep executing at an exceptional pace just to justify the price the market has already assigned it. So let's bring it all together. On the strength side, NVIDIA shows extraordinarily high margins, a fortress-like balance sheet with far more cash than debt, minimal borrowing risk relative to its earnings power, and returns that dramatically outpace its cost of capital. On the risk side, several valuation multiples, like price to free cash flow, are elevated. The stock carries a beta well above the market average, meaning bigger price swings in both directions, and the dividend yield remains minimal compared to the size of the profits being generated. Both the strengths and the risks are sitting right there in the numbers, side by side. And that leaves us with one real question to sit with, as this company already sits near the very top of the entire market. How much more growth is realistically left to unlock, and can NVIDIA keep proving quarter after quarter that it deserves the price the market has already placed on it?